It appears as though it's risk off for investors. They're moving into safe haven assets, and there are a lot of reasons why.
Welcome to Gold Silver Pros. Searching for the best precious metals deal? Shop with our trusted partner, ARC Silver. Access special deals on silver, gold, and platinum through our website, or call 307-264-9441.
Hey everyone, this is 𝘎𝘀𝘾𝙊𝙈 with goldsilverpros.com, and I'm reporting about 3 p.m. Friday, Central Time, January 27, 2023. This is the weekly market wrap-up. Title of this one is Massive Inflows to SLV Indicate Investors Rushing into Silver. I'm going to get to that story in a moment. But in addition to that huge breaking story and the potential implications of that we'll talk about, and what it could possibly mean, we have a very, very, very heavy and impactful news week. So there's going to be a lot here. This is going to be a pretty chunky presentation, guys. I'm going to go through the most relevant stuff. We're going to do our usual gold silver thing, and I'm going to bring you some of the stories of the week that I think are going to be hugely impactful. It appears as though it's risk off for investors. They're moving into safe haven assets, and there are a lot of reasons why. And man, we're just going to jump right into it. At the time of this recording, gold is trading at 1928.64. Silver is trading at 23.56. Both are down very slightly on the day. Over the last 6 to 7 days, gold and silver are almost completely flat. Gold rose and fell. Silver fell and rose. Opposite patterns, which is fairly unusual for the metals, but it does happen from time to time. But in the last week, if you hold gold and silver, you're pretty much at the exact same place you were last week. That being said, that's just the prices. We'll talk about how people are absolutely debating the precious metals here in a moment. Getting on to the economic indicators. The leading economic indicators index is down 1%. That is deflationary and not good. And what I want to do is do a share screen on which leading indicators we're talking about, because there's a batch of them. So economists at the conference put together this little chart of leading indicators. And basically, it's a collection of like the top 10 things that they look at to see where the economy is going. You can see almost everything's negative here, and therefore the index itself is down about 1%. The S&P index of stock prices, the leading credit index, the interest rate spread, the 10-year T-bonds, less federal funds rate, average consumer expectations for business conditions, ISM index of new orders, building permits, average weekly hours, so on and so forth. And that indicator is trending towards recession. As we dive deeper into the economic data, the S&P U.S. manufacturing PMI is down. And there we go. Sorry, trying to get to the right article. Yep, U.S. economy comes off to a weak start. The PMI in 2023 S&P finds. So I'm going to read from the article. The U.S. economy got off to a weak start in 2023. Business conditions contracted again in January as demand for goods and services fell for the fourth month in a row, the S&P survey showed. The S&P Global Flash U.S. Services Sector Index rose to a 3-month high of 46.6 from 44.7 in December. The service side of the economy employs most Americans. The S&P Global U.S. Manufacturing Index, meanwhile, edged up to 46.7 from a 31-month low of 46.2 at the end of last year. Any number, however, below 50 suggests a contracting economy. So both the service and the manufacturing sections of the economy are basically going into recession. We look at initial jobless claims. They come in at 186,000. That is 6,000 less than last month, and the expectation for economists was that we would actually spike quite a bit more to 205,000. That didn't happen. That's actually a little bit good for joblessness and employment in the United States. Continuous jobless claims are about what people expected at 1.68 million, slightly higher. Real gross domestic product is 2.9%. However, it is falling, and I'm going to show you a chart on that as well. I'm sharing some of these economic indicators on the screen because I think they're so important. So the economy did have some growth back here, but you can see this general sort of fade back down to about the zero line. So this is last year when we had a negative 1.6 print and a negative 0.6 print about. We've been positive to end the year, positive GDP of 3.243 and 2.892. Now, if you decrement these for inflation, they're actually slightly negative. But in any case, it looks like the economy is not growing. It's headed toward recession by most of these indicators, including groups of the leading economic indicators. Trading goods, which is our trade account, means how much do we buy versus sell with other countries in the world, is a negative 90.3 billion. That is not a good number, ladies and gentlemen. We're sending more money out than we're getting in a deflationary economy. That's not good for the domestics. Durable goods orders up 5.6%. So nice to see some of the durable goods getting taken off the shelves. Chicago Fed National Activity Index down 0.49%. Core capital goods orders down 0.2%. We did see a slight uptick in new home sales to 616,000 on expectations of 615. Last month we had 602,000. So a very slight rebound in new home sales portion of housing. Overall, the overall housing is not doing well. On Friday, today, just earlier today, 8:30 a.m. Eastern time, we got the PCE price index year over year at 5%. That is a internal government measure of inflation that's very similar to CPI, but not quite the same. I'm not going to go too much into detail. University of Michigan Consumer Sentiment Index is 64.9, slightly higher than last month. Pending home sales up to 2.5%. They were down 2.6% last month. So it appears as though people are trying to get back into housing as the economy, the markets look like they're a little bit frothy. We'll get into that right now. Maybe a little bit of a head fake in housing. I don't think the long-term trend on housing is positive, but we did have a nice little boost beginning this month in January. Getting on to the markets, the Dow Jones Industrial Average is up 40 points to 33,988.96. The S&P 500 is up 10 points to 4,070.93. The NASDAQ is up 114.5 points to 11,627. And the Russell 2000 index is up 14 points to 1917. All of the markets are up, but less than 1%. So a nice little update to end the week, but nothing terribly important to speak of. We're going to move over to bonds. The bond market investors are some of the smartest investors in the world, and we're still in yield curve inversion. For those of you that do not watch the weekly market wrap up or haven't watched and are joining for the first time, first of all, welcome. We go over all the economic data. One of the things we look at is the bond market, because I believe bond investors are much smarter than most investors because of the way that the bond covenants are structured. And the risks there, and the bond investors, I think, do a better job of looking at macro and microeconomics. The 10-year U.S. Treasury is trading at 3.518%. Every other shorter-term Treasury is trading at a higher rate. The 7 years at 3.576, almost in parity with the 10-year. And it appears as though the market thinks that the short-term risk is coming down a little bit because some of these shorter-term issuances have moderating interest rates, although they're all up today, but they're all up today only slightly. The 3 years at 3.906, the 2 years at 4.205. So there's about a 0.7% difference between the 10 and the 2 year. And when that 10 and 2 year invert, meaning the 2 year demands a higher rate than the 10 year, it means risk is here right now and we're expecting a recession. That's why the yield curve inversion is the most important indicator of an oncoming recession. And indeed, most of the market analysts do expect us to have a recession this year. Just about everybody's called it. We'll see what happens. Even though the markets are ebullient right now, from a fundamentals perspective, everybody's expecting a recession. Bitcoin is down at the time of this reporting about $17, although it's fluctuating a lot. It was up when I looked at it 2 minutes ago. It's down right now to 23,088. We'll see where it ends the day. Ethereum is down 8 to 1598.55. Litecoin is up 0.65 to 88.08. And XRP is down to 0.41, unchanged on the day. Not a lot of trading going on in XRP. Some very important news that we're going to get to. First one is some domestic protests. Georgia governor declares a state of emergency over Atlanta protests and mobilizes 1,000 National Guard troops. Georgia Governor Brian Kemp has declared a state of emergency on January 26, allowing up to 1,000 Georgia National Guard troops to be brought in to help deal with violent protests that are broken out in recent weeks, with further demonstrations anticipated over the weekend. The declaration is effective immediately and will expire on February 9th unless extended by the governor. Specifically, the state of emergency is being activated owing to unlawful assemblage, violence, overt threats of violence, disruption of the peace and tranquility of the state, and the danger existing to persons and property. That is from the Georgia government, according to that declaration, under which all resources of the state of Georgia would be made available to assist in the ongoing response to the state of emergency. Masked rioters lit fireworks in front of Atlanta Police Foundation, shattering large glass windows and vandalizing walls with anti-police graffiti. At least 3 businesses were damaged when bricks and rocks were thrown at properties, according to local reports. In some instances, protesters used hammers to smash windows, and a number of police vehicles were also attacked during the protest, with at least one set on fire, according to the reports. As well, we have some increased geopolitical risk. We broke this, I think, yesterday. The U.S. is poised to provide Abrams tanks to Ukraine in defense of their territory in the Russia-Ukraine war. Germany said Wednesday it would send 14 Leopard battle tanks to Ukraine and approve re-export of the same kinds of tanks from partner countries like Poland. So both the U.S. and Germany are sending heavier artillery, heavy tanks, and heavy personnel moving equipment over to Ukraine to help in that defense, getting more and more involved in the war from a U.S. perspective. So both domestically and internationally, we are seeing some riots and other geopolitical risks that I think has people thinking risk on, go to safety. And I'm going to explain to you in a moment why that's important and where people are going to safety. We're going to share the screen again, and we're going to do our precious metals review. We're going to start on the CME Group's website on gold, as we always do. You can see the prices here. Volume and open interest is still elevated. It has been for most of the month. January has been a very interesting month in terms of fraudiness in both the gold and silver derivatives markets, where the spot price is determined. And the first thing I'm going to look at is exchange for physical. It's at 37.92 gold contracts for Thursday. We don't have Friday data yet. It's a little bit too early. But for yesterday, 3,792 contracts EFP. What is EFP, or exchange for physical? That describes when somebody has a contract in COMEX and goes over to alleviate that contract in the London OTC market. So across the pond, it could be looking for physical delivery of the gold, or just trading paper, exchanging paper for price arbitrage, or to extinguish positions in a different market. It's fairly common. All the EFPs have been elevated, and leads me to believe that there is significant price differences between gold and silver in the U.S. market and in the London market, and further that there may be some potential delivery issues with gold and silver in the COMEX market, because we're seeing enhanced deliveries. On the data today, we don't see a lot of deliveries on the contract, but we have been seeing them to end the year. There were 243 gold contract deliveries for Wednesday's data, as well as 4,513 EFP exchanges. And essentially, I think that means is there is a difference between the liquidity of the available gold and silver in the London market and the U.S. market, and those two columns, deliveries on the COMEX market, this is delivery on the U.S. market, versus moving deliveries or price exposure over to the London market, which is this one, indicates the two markets are not in sync. Okay, and that's why I depend on the CME Group data to get me spot price instead of trying to look at London, because the two are not in sync, and it's clear that there's some divergence in those markets. And by the way, that has been increasing the last 2 years. The London and the American markets are not completely aligned, and different things are going on in those markets as people position in the precious metals. Going to, we have some early Friday reported data for settlements. This is updated, not quite real time, but the heavy contract month for gold is February 2023. We also are moving into April. So you can see that there's been a fair amount of movement into April as a dominant contract month. It's behind only 8,000 contracts from February at 137,232. So if you want to know the spot prices, you would need to look at both of these markets, because both of them have significant activity. Dating in April, the price is 1945.60, whereas in February it's 1929.40. That is a normal market. This will determine the current spot price more like. But this is an indication of where the market sees gold going in a couple of months. They see gold going up from 1929 to 1945. That is a very bullish sign for the market. And as people extinguish their February derivative positions and move into April, we expect the prices of gold to continue to move up. That is the data for gold. Let's go over and look at what's going on in gold across the world. This is the COMEX data we just looked at from the CME Group. But here we're looking at it from an ounces perspective and not a paper trade perspective. This is physical. So that market COMEX, there has been about 1.7, 1.8 million ounces over the last 4 weeks. This is a 4-week indicator, has moved off of COMEX. And overall, some of that has actually moved into London. So London, I think, is accumulating gold right now, whereas the COMEX is losing this. If you add these numbers up, you have about 1.8 million ounces coming off of COMEX overall. only 1.2 across. So that means 600,000 ounces actually come in to the London market. Remember when I said there are differences in ability to deliver and why we saw those exchange for physicals? This indicates why COMEX is bleeding gold, London is adding gold. And so therefore, I think what's happening is as the COMEX in the US bleeds gold, there's a limit to the amount that people will deliver. That's why the EFPs are going over to London, because they're actually adding gold to their coffers. So it appears as though, looking at the data, London is much more liquid. Hence, go back to the volume in OI, much more liquid, hence all these EFPs. Because this is people saying, we're using the COMEX contracts to go get the gold in London. Why is that? Because COMEX is bleeding, but London has more liquidity. They're adding 600,000 ounces at a time when COMEX is losing 3 times that in 1.8. So that's very interesting. If we look at the dominant passive vehicle for gold, the ETF, the GLD, you can see that there's been a fall since silver squeeze about a year ago, getting close to a year ago. It's the last 2 trading days in January of 2021, 2 years ago, and the first day in February. And since silver squeeze, gold stocks have fallen basically across the world. However, some is being added to London. So London's getting that liquidity. Let's look over at silver. Spot price on COMEX 23.67 as we report this. Frothiness in the silver market, lots of position changing. Now, as we get towards the end of the month, a lot of this position changing is just moving out of this month into a futures month. And that's what a lot of that is. So as we look at the Thursday data, you can see the dominant contract month is still March. And you can see, however, that people are starting to move into May a little bit and into September as we rotate into future months. You can see that here in the change column. So 371 contracts came into March for silver, 912 came into May. So May looks like the next big one. Exchange for physical on silver is a little bit elevated, 840 contracts of 5,000 ounce silver with only 12 deliveries. When this number, the exchange for physical over the London market, is significantly higher than this number, which is actual physical delivery in COMEX. That tells you which is more liquid. London's more liquid right now than the COMEX. That's why contracts are moving over. And if we go back a day and look at Wednesday's data, you're going to see the same thing. Only 7 deliveries and 329 moving to London. Now, why is that the case? Well, January is not a big delivery month for silver. There's not a lot of contracts on it. And so you're not going to get a lot of deliveries. There's not a lot of contracts out there. There's only 13 contracts left in January. So what people are saying is January is not a big delivery month. And to understand how physical delivery happens on COMEX, the commodities exchange in the US, only 6 months of the year for both gold and silver, and they're different months most of the time, with the exception of December, the year-end month. They're different months in which gold and silver have big delivery months. So people don't deliver every single month, because originally COMEX was not set up as a big delivery market. But people are wanting physical delivery of silver, especially for both industrial and investment purposes. So where this is not a dominant contract month, January, the current month, to get silver deliveries off, there's just not a lot of people participating. They're going to have to roll it over to London to get exposure there. And when that March contract is eligible for delivery, which would be at the end of February, the last couple of business days of February will start, I think you're going to see a lot of deliveries on that March contract. So I expect a lot of physical deliveries in March for silver based upon this EFP data. But since this is not a big, heavy delivery month, there's not a lot of people on the market this month. It's one of those sort of dead months where you just play the paper and you don't have a lot of physical delivery. That's why you're seeing people grass out of London, and that's where you see people coming to London. So the next time the London numbers come out for the January, I expect to see an influx of both gold and silver there because people are trying to get exposure. If we look at settlements for silver, you can see that the dominant month is March. You see some people moving into May as well. So May will be the next dominant month for both gold and silver. Estimated volume 62,283 as of Friday. This is live data, basically. They update as they go along, an early preview on that. And the reason they do this on the settlement is so that if you're watching the website, you can see it settle almost in real time. And so that's why the settlement data is updated every day while the volume isn't. The volume is not quite as important to price. The settlements are, and that's why you'll get settlement data throughout the day on the CME Group's website, where you won't necessarily get the open interest. It'll come at the end of the day, if that makes any sense. All right. So that being said, closed down 40 cents to 23,622. And again, gold and silver essentially over the last 7 calendar days are almost exactly even. I don't know if they're going to close up or down on the day, but I don't expect there to be big movement in the actual derivative prices over a week. If we go to the chart on silver, what you're seeing here is a whole just ton of silver moving off the COMEX. This is the American market, these 3 lines. It's 11, 12, 18 million ounces over the last 4 weeks has moved out of COMEX in silver. People are taking delivery of silver, okay? A ton. Daily change is very high too. Look at these daily changes of redemptions. If we move into the London market, you can see silver may actually be coming on because net, there's been an increase of 4.1 million ounces of silver across London and the US. The US is negative, 13? So that means London had to add a whole bunch. And here's the big news of the day. The SLV is now getting an absolute crap ton of silver in it. Why? People are going to safety. Remember, risk on. People don't believe in this market. They expect that we're going to have issues with the economy. They're listening to everybody say we're probably going to have a recession. They know that the Fed is tightening the monetary environment and the credit environment, so things are going to start to slow down the economy. That's done intentionally. And so what happens, people are going back in SLV. Now, the last time we saw a huge movement into SLV, it was 110 million ounces during Silver Squeeze. It was this lead up right here. Boom. This is Silver Squeeze. And then after Silver Squeeze, you saw the redemption out of SLV as people realized, well, SLV is not going to give me physical ounces, so I'm going to sell my SLV shares and go buy physical silver. And we saw that with silver deliveries. It seems to be repeating again as we have risk on. The retail sector is adding over the last 4 weeks 11.7 million ounces to SLV. They don't have redemptions, right? Only the authorized participants with 50,000 share baskets can do that. Authorized participants are basically the same as the bullion banks on COMEX. And so at the end of the day, what's going to happen is people are going to realize they can't actually get the silver. And I expect that demand to come out of SLV and go into physical, just like it did back here in 2021. But we'll monitor that for you guys. Are we going to have Silver Squeeze part 2? I don't know. Early signs indicate people are going for the silver. We could see some sort of Silver Squeeze here in the first quarter. Will it be the same as what happened 2 years ago? We don't know. Although I find it uncanny. The timing is almost exact because the original Silver Squeeze was in January and February as well 2 years ago. And now January, February, we're doing it. Now, why does that happen? Because in January, a lot of money sitting on the sideline comes back into the market. So all markets. And so people are bidding up silver. So every year or 2 years, you could see this happen in the precious metal. You see a lot of money coming back in January. Will that actually lead to a squeeze? I don't know. There's not enough ounces over the last 4 weeks to matter. Last time it was 110 million ounces. This is only 11.6. So it's a much smaller movement, but it's still a huge movement into SLV. And what that tells me is people are going for the silver. Now, if you look at the iShares Silver Trust, SLV, the fund flows charts on etfdatabase.com, you can see on the 23rd, which would be the last month or Monday of this week, Monday of this week, we had a massive 439.2 million ounces move into, $439 million, move into SLV. And the ounces you're seeing are basically this over the last 4 weeks. So this is a huge part of that increase into here, which is why we didn't see this frothy of a number until this week, because Monday of this week, people went severely long SLV, That is huge. And if you want to look at the 3-year chart, this is Silver Squeeze right here. These 3 days these 2 days are Silver Squeeze. This is Silver Squeeze, which caused a massive jump in price to silver to around 30. We don't have quite the same level of silver investment into SLV. So this is not, it's only about a third. So we're about a third already of what Silver Squeeze was back 2 years ago. So it's not quite the same level, but you can see this has been the highest level since Silver Squeeze. No other period of time have we seen SLV in the last 2 years add as much investment in one day as we have a Monday this week dating back to Silver Squeeze. So again, this is a substantive change over the flows and SLV over the last 2 years that needs to be looked at. It's pretty serious. Now, what does the rest of the market do? And we're going to go to the CFTC COT report. This is the commitment of traders. This is a big, nasty, ugly, scary looking chart to some people, but it's just a table of numbers. And trust me, as a former auditor, it's not too bad. And I'll explain how it works. If you've never seen this before, if you come to the weekly market wrap, I'll read it out every week and explain to you how it works. First or second time you look at it, you'll get it. It won't be scary anymore, and you'll be able to read this yourself. In fact, you will find yourself every week hitting cftc.gov, looking at the COT report and saying, are you refreshing? Are you refreshing? Because once you know the importance of this, you're going to be like, oh man, I need to follow what's going on there, because that tells you where the market's going. Now, this data is in arrears. It's as of January 17, 2023. It's 10 days old. about every week to 10 days. The CFTC prints this report, but it's in arrears. It's backward looking. So this is going to tell you why, silver and gold have gone up or down over the past week, but it really informs us as to positioning and what's likely to happen. So, we're looking at silver here on the COMEX. And the biggest thing that I see really is just a reduction of shorts and going along by managed money. Managed money for about 3,200 contracts is net going long. So they're adding long position to silver, getting frothy, saying we want to go into silver. The other reportables are opposite. They dropped 546 longs and went a little bit more short. Positioning from the swap dealers is about even. You had long and short almost identical. You saw a massive amount of $2,500 shorts in the producer merchant category, which is perfectly understandable. This category is the non-speculative category of the COT report. It is the hedging. And why does that make any difference in the world? Because the producers who pull it out of the ground need higher silver and need as high a silver price as they can get to maximize their profit and pay costs. So if they feel that silver market's going to move one way or the other, they'll buy a corresponding derivative position on the market to protect their price risk. That paper trade can be sold and recover the profit to offset the loss they actually had in the physical market when they went to sell. So for example, if you're a producer, let's say silver right now, we have it trading at 23.57 and the producers think that it's going to fall to 22 bucks. They'll add shorts on the derivative market. And if they sell it at 22 bucks, their theoretical loss was almost $2 on the silver price. They'll offset that with a short position on COMEX. They'll cash that in and they'll be made almost whole. So think of this column as an insurance policy against price movements and the actual metal. The rest of this, all these other positions here, that's just speculation. They're just playing the paper for the most part. Now, there are some physical deliveries involved in here, but mostly it's a paper trade. Moving on to gold, we see a massive movement in gold. The swap dealers went net short by over 8,000 contracts, 8,200 it looks like. The producer merchants went long about 4,000. You see the other reportables, the family offices and the wealthy individuals going net short about 4,800 contracts. They dropped a bunch of longs and went short. And so what they're seeing is a little bit of weakness in gold, and that's why gold has faded a little bit. This data determines price. You can see that gold is going to be fading just a little bit. But the managed money, the financial types, the broker dealers, the financial houses, the hedge funds, and all those guys went massively long gold. And that's why you saw so much support for gold. The financial types are going into gold. We had articles this week and videos this week talking about Jim Cramer and him making a bullish call on gold, and me coming out last night on my channel saying, I believe that we're in a gold bull market. Now, I do think that there's going to be an intermediate term pullback because the gold got really frothy. And I think as it approaches its next target on the Fibonacci chart I provided to you guys a bunch of times, or a technical trading chart, I expect it to bounce off of the next important trading level. And that's explained in those videos what that means, and probably come back down and maybe even move sideways for a little while. But longer term, I think that we are in a big gold bull market. And I think the managed money or the financial types believe the same thing. That was just action packed. There is so much going on, guys. The economy is deflating as determined by almost every single metric. People are going to safety. We saw massive inflows into SLV. SLV is an ETF. It's a passive fund. So when money goes in SLV, it's coming out of other qualified investments or other major market investments like 401ks, bond markets, things like that. People are moving into SLV using passive vehicles, passive funds. And so that tells you it's risk off. People don't want to take risk. They're not going to be in risk. They're moving to safety. And the DXY, the dollar index, is falling. So they're not moving to the dollar. Bond rates are relatively even on the weekend, give or take, even on the weekend. So people aren't moving into bonds or moving out of bonds. You're just kind of letting bonds sit there. But the move on a lot of the money has been into both gold and silver, and we saw that on the charts. I think it's very positive. I think Jim Cramer has it correct this time. I think we have it correct, although I do think we can expect gold and silver weakness price potentially over the next few months as we work through what's going on in the economy. If we do have a pullback, it's a natural pullback. It's a consolidation, like a mid-move consolidation that I expect us at the end of the year to be much higher, given all the risks that we're looking at. And given some of the domestic risk in Atlanta, and the economic data and the geopolitical risk in Ukraine and some of that heavy artillery moving in there as they move to the next stage of the war, getting into entrenchment and getting into heavy vehicles, it's apparent that the world is in a bit of a state of flux and a lot of risk. So all the investors are going risk off and saying flight to safety, flight to safety, flight to safety. Where do they go? Gold and silver. So I think that's why we've had that nice pop in January for gold and silver. The next thing I'm looking for, and I say this, every week in December and January, is those earning reports from companies. We know that sales over the last quarter of the year were down 1.1% retail. So even the holiday shopping season didn't save us. And when you decrement that all for inflation, we're actually down quite a bit. Inflation itself is coming down, indication of a deflating society. We're going to go in stages. We're in a mini deflation. We're going to have inflation, mini deflation, and then one big more inflation. I think if the past is any indicator, and so we'll cover that. So the economy is going to get, this is where you're going to have more violent price swings, more volatility in most markets, whether it be gold, silver, whether it be the bonds, whether it be the stock market, whether it be real estate. You're going to see bigger price swings this year than you've probably seen in other markets because we're battling deflation, inflation, deflation, inflation. Those stages we go through as we move through that massive inflationary cycle into the financial reset and the establishment probably of some new world currencies. Of course, in recent weeks, we've talked about China, Iran, Russia, et al. Setting up alternative currencies backed by gold and alternative systems to trade value and money outside the Western system. So that's de-dollarization, and that continues to march on. And I think that's one of the reasons why the dollar index is falling, and that's been bullish for both gold and silver. All right, so much going on this week, guys. Woo, that was a big one. I think this is going to wrap it up. We'll be back next week. Now, as a reminder, by the time you watch this video, I'll be having given my presentation in Vancouver. If you're at the 𝘎𝑃 conference in Vancouver, feel free to stop by. It's at Vancouver Convention Center, which is down by the bay. I've been several times since 2018. I love this conference. It's a great one. I'll be at the Stock Pulse booth. I believe it's 509, but you can look at the booth map and come see me there for a period of time, and then I'll be milling about when I'm not giving my presentation. So if you see me, come up and say hi. All right, this is going to do it. Everybody have a blessed weekend. I will see you guys next week. This has been Rob Keats for Gold Silver Pros.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.